I put it down that the governments and the Fed are absolutely petrified of a carbon copy of what took place in the early 90s.
Generally speaking, the stock market is now 15%.
If you're reading the market now, there's more pressure on interest rates to run probably up. The 4 banks I've spoken to just yesterday to confirm before this interview, there's likely to be another rate increase in August and potentially one more before Christmas. They're not certain about that yet. The main reason why we're getting massive increases in interest rates is because of the cost of global credit. And global credit now has become far more expensive. Time premiums have been priced out and pushed out. And that credit, both corporate and private, is being has not dissipated because of the international borrowings. So, for example, if we're borrowing from China, the US, on the backing of a different currency, we're paying a premium on that. Well, there's been no relief or alleviation on those foreign borrowings. And so that means that the pressure is still on, and that credit ease and pricing hasn't dissipated. And what that means is that if you go back to 1990, 1991 and 1992, where they started to ease inflation, ease interest rates to try and get a hold on inflation, and they brought the rates down 2 or 3 times. Inflation got away like a virus and sent rates from 9s to 18s. Listening to a lot of commentators in the marketplace, everyone's talking about, well, why aren't they moving rates down? The Fed should move, the Reserve should move. I put it down that the governments and the Fed are absolutely petrified of a carbon copy of what took place in the early 90s. So whilst the discretionary spending has eased and tightened, that I think the governments, the Fed, will these rates are here to stay, give or take, for the next 18 months. And the governments will need to be worldwide, not just Australia, completely satisfied they've got inflation under control. Now, it doesn't help. This is leading on to other aspects of the economy, and there's all knock-on effects, cause and effect, that when you've got wage pressure, unions coming out and government support, and tax changes, amendments to the marginal tax rates, which then forces wages up, and the cost to produce, that doesn't help inflation. So that's pretty much, it's a knock-on. So I see it more of we're at a bit of an impasse at the moment, I think, with interest rates. I don't believe that, and it's got to do with the foreign borrowing and private and corporate debt. There's no alleviation. And so it means if your parent borrows, forget the banks for a moment, it's the government. This government has debt to other nations, like the US. I mean, 44.6% of the US economy is owned by China. And so they've got a much bigger problem. The one alleviation they've got 348 million taxpayers, or population, with 58% under the age of 60 in the workforce, where Australia's got 25.4 million people and 15.3 million taxpayers. So we've got 60% of the economy. So it's like running a 10-cylinder engine on 6 cylinders. So it just doesn't have the output. So interest rates at the moment are going to be where they are, I think, give or take 25 to 50 basis points for 6 to 18 months. And so that's where we sit.